Oil markets have continued their wild ride with no firm agreements from major oil producers on whether to lift production to cushion the effects of the war. This chart shows just how wild oil price volatility has been since the invasion. This week, Brent crude notched up a 14-year high of $139 a barrel, but then suffered its biggest one-day crash since the peak of the pandemic, back when the oil price went sub-zero. And the volatility isn't over. There remains the threat of more sanctions. The US has said it will no longer buy Russian oil, but that's small fry. Europe and China currently take around 85% of Russia's crude exports. So what happens to oil prices going forward depends a lot on them. Oil prices fell by around 2% overnight while gold climbed. So far, the volatility in the oil price isn't having the same severe economic effect as the oil shock of the 70s for a few reasons. One is demand. As this chart shows, the world needs far fewer barrels of oil to produce economic growth than it used to. So there's some good news. But it will be cold comfort to Americans paying through the nose for their gas at the moment. US inflation data was released overnight and it hit a whopping 7.9% in February. Energy was the standout. It was up 26%. US markets dropped overnight and European markets were savaged. Our market today dropped and it's down 0.7% for the week. Mining firms Worley and Rio Tinto, just two more companies trying to distance themselves from Russian partners and projects. The Australian dollar has continued its wild ride as well. It's back above 73 US cents for now. Westpac forecasting it to hit 76 by year end, thanks to high commodity prices. That's finance.